Hello, and welcome to our webinar on target date funds. I'm Joe Arns, the founder of Reason Investments. Reason Investments is a registered investment advisory firm that provides sophisticated advice to individuals and other investment advisors. Over the next few minutes, I'm going to address the hottest trend in 401k plan investing, target date funds. I'll talk about the concept behind target date investing, address its flaws, and suggest an approach that will leave most people better off. Target date funds now manage more than $1 trillion of wealth here in the US. These funds are billed as a simple automated way to invest for retirement. And they are, but rapid adoption of target date funds is not a consequence of employers sitting down and deciding that these are great investments for their employees. Their popularity stems from the fact that a federal law passed in 2006 encourages employers to automatically enroll their employees in workplace retirement plans. If an employee participating in a plan with automatic enrollment fails to designate their own investment choices, the employer can direct those funds into one of three default options okayed by the US government. Either a target date fund, a fund with a balanced mix of stocks and bonds, or a professionally managed account. Balanced funds give everybody the same mix of assets regardless of age or other circumstances, and professionally managed accounts carry higher expenses. So that sort of leaves target date funds, which at least vary the mix of assets by age, as the sort of default option for most plans. So now they're included in most investment plan menus around the country. But again, the policy goal here was not to give everybody the very best investment options, merely to boost plan participation. While that's a good policy goal, the consequence is that many people likely believe they're riding a wave of innovation by investing in target date funds, when that's not really the case. The concept behind target date funds is that every investor has two types of wealth. The first type of wealth is financial wealth, things like bank deposits, stocks, bonds, and funds. The second type of wealth is what's known as human capital, the value of all your future income from working. To measure total wealth, you need to add both values, financial and human wealth, together. For younger investors, human capital usually accounts for a large fraction of total wealth. The theory then suggests that this human capital is somewhat like a bond, such that a younger investor can afford to invest a larger portion of their financial wealth in risky assets like stocks. For investors at or near retirement, most of their wealth is in financial assets, so they should have a lower allocation to things like stocks. In addition, theory suggests that younger investors can afford to take more risk with their financial assets, since if they lose their money, they can afford to work longer or harder than they otherwise planned. Based on this concept, target date funds tend to put roughly 90% of assets in stocks for investors up to around age 40, as you see on the chart here. By age 65, these funds have reduced the stock allocation to roughly 30%, and the majority of fund assets are then sitting in bonds. In between ages 40 and 65, the funds step down the exposure to stocks according to a chosen formula, something they call the glide path. The exact allocations to stocks by age will vary by fund provider, but all are going to follow this basic pattern. This target date approach is only as sound as the concepts and theories behind it, and there are three major flaws in the thinking behind target date funds that make them useful for only a small group of investors. The first problem with target date funds is that it turns out for most people, human capital acts more like a stock than a bond. Part of this is because of the changing nature of work, where people have more jobs than they did in previous generations. There was a government study put out last year that found that people born in the latter part of the baby boom, say from the late 50s to the mid 60s, held an average of 6 jobs between ages 25 and 50. And this number will probably be higher for Gen Xers like myself and for millennials. A greater number of jobs means more gaps in employment, especially when job changes are involuntary, and more changes in pay. Here's a simple illustration of yearly changes in income for a typical household with a 40-year working career from, say, their mid-20s after college to their mid-60s. You can see that in most years, the change in income is very low, probably in the single digits. Most of the time, the economy is going to be expanding. Employment by a husband and or wife will continue as it did in the previous year with very little changes in take-home pay. But over a 40-year period, a household can be expected to weather a handful of recessions and the risk of job loss or a temporary drop in income that goes with it. In addition, there may be desired job changes. Maybe one or both spouses want to change jobs because of a lifestyle change or for career advancement purposes. And these types of events tend to lead, not surprisingly, to large changes in income. For example, in the illustration we see a year where income falls 50%. That could be a period of extended unemployment, followed by a 100% increase the following year, which could be someone returning to the workforce. These infrequent but large fluctuations in household income suggest that the typical household has human capital with risk similar to an individual stock. So unless your employment is highly stable or guaranteed, such as if you happen to be a tenured professor, one of the key theories behind target date funds is undermined by real-world data. Problem number 2 with the target date approach. Stocks are not safer just because you might have a longer time horizon. You might say, okay, fine, my human capital is risky. But what about the idea that I can take more investment risk when I'm younger since I have more time to recoup any losses, plus stocks always do best in the long run. So another theory behind target date investing suggests that younger workers can simply work longer or harder or both if their investment returns are less than expected. And that's true in theory if you assume that you'll have the flexibility to work several years into what is normally retirement age, or you're able to work more than one job. But ask yourself this, isn't life already busy? Do you really have the capacity to work even more if your investments do poorly? For most of us, the answer is going to be no. This is another example of an academic concept falling flat when faced with the real world. Okay, now for the idea that stocks always do better than safer investments like bonds over long periods of time. The evidence here over the past 100 plus years supports that argument. But I would argue that doesn't prove stocks are safe for you as an individual investor over long horizons, even if we set aside the possibility of some devastating event that could permanently hurt the stock market, such as a serious pandemic. The greatest risk to your portfolio isn't the stock market itself. It's how you personally react when the market goes into a nosedive like it did in late 2008. As the equation suggests on the slide, U plus panic equals an empty wallet. A study by market research firm Dalbar Inc. showed that the average investor in stocks earned barely half of what the S&P 500 returned over a 20-year period. That's a huge discrepancy, proving that many investors act on emotion and tend to buy more stocks when prices are high and sell when prices are low, destroying their wealth in the process. Over a longer time horizon, there are likely to be several periods of stock market mania and panic, giving the individual investor several opportunities to sabotage their own financial wealth. The third major problem with the target date approach is this implicit assumption that age is the best indicator of risk tolerance. The academic literature on this is decidedly mixed, but for whatever reason, in practice, age has remained the dominant factor that people use when trying to figure out how much risk you should take. We conducted our own study of 2,600 investors to find the factors that best explained financial risk tolerance. The chart on this page lists the factors we found to be statistically significant. The font sizes you see here of each factor listed show their relative importance. As you can see, people's own intuition about their risk appetite is an important factor, as is their choice of job, their education, their expected income in the future, and their level of investment knowledge. In total, our research has identified 10 significant factors that we'd like to know when assessing your risk tolerance. If you're looking for age, you're not going to find it. That's not to say that age is irrelevant, only that it appears there are more important factors. By now, we've poked several holes in the target date approach. Here's the target date fund chart we showed earlier. I've added a black line that shows a constant percentage of stocks for all ages at a level appropriate for an investor with average risk tolerance. We see that for the younger investor, there is a risk of selling low during the next market downturn, as the stock allocation is far too high to withstand such a steep drop in value. For the older investor, we have a different problem. In this case, we aren't investing nearly enough in higher returning stocks and are leaving too much money on the table. With the target date approach, we are faced with one problem or the other at almost every age. For all but the most aggressive or most conservative investors, the target date portfolio will only line up with the portfolio that best suits our risk tolerance when the two intersect at a single point in time. That means that for most of the time, the target date approach is likely costing us money. The better way to invest is to target a portfolio that offers the best potential return for a level of risk you're comfortable tolerating, meaning that you'll be able to hold on to risky assets like stocks when the prices fall and hopefully have the courage to buy even more. You want to target risk instead. You won't risk selling low because you are taking more risk than you should, and you won't be leaving money on the table because you're not invested aggressively enough. How much risk can you tolerate? You probably already have some intuition about this, but we've designed a free online tool based on our research that can help you better quantify just how much risk you ought to have in your 401k or other investment accounts. Just visit arcpointadvisor.com/arcpoint/risk. The online assessment takes only 5 to 7 minutes, and once we receive it, we'll review it and send you an email with a basic recommendation on how to allocate your money. To sum up, target date funds simply aren't appropriate for most investors. Your future income from work is usually highly uncertain, undermining the concept that you should hold a riskier investment portfolio when you are young and a very conservative portfolio when you're in retirement. Stocks are not really safer just because you've got a longer time horizon, primarily due to the human tendency to act on emotion. And finally, age is hardly the best indicator of risk tolerance. Every investor owes it to themselves to assess their willingness to take investment risk, either using a free tool like ours or by working with a competent investment professional. Once you know how much risk you can take, you've taken an important step toward implementing a financial plan that you are more likely to stick with through thick and thin. And if you can stick with a thoughtful financial plan, you are much more likely to meet your goals. Thanks for listening, and please contact me with any questions you have on what you've heard today. Email, LinkedIn messaging, and phone are all good ways to reach me. Have a great day.